In this series, we've talked about a lot of different strategies. Some have attempted to minimize your risk of running out of money, usually by adjusting your ongoing withdrawals based on the remaining size of your nest egg. Others have tried to maximize income, either by trying to use up all of your money by a certain point in the future, or by using return-adjusted withdrawals. And still others have attempted to maintain your buying power over time to keep your income relatively steady and predictable, even when the returns of your investments aren't. Today, we're going to be discussing a strategy that, in a sense, is attempting to do all three. It's known as the CAPE-based withdrawal strategy and is inspired by Robert Shiller's cyclically adjusted price-to-earnings ratio. The thing that really sets this strategy apart from all the others that we've covered is that it, unlike the other strategies, is forward-looking thanks to its use of CAPE. But as we've discussed in past videos, the markets can be pretty unpredictable, and even our best metrics to estimate future performance are far from foolproof. So, does this forward-looking approach actually help the CAPE-based withdrawal strategy thrive? Let's find out by discussing the pros and cons of CAPE-based withdrawals. But before we get going, be sure to like this video if you haven't already, as it really does help out the channel a lot, and subscribe with notifications on for more money-related videos like this one every single week. And if you want to further support this channel, you can check out some of the links I've left in the description below, which includes a link to the investing platform M1 Finance. Get started investing for free today. Before we get into the analysis for this approach, I want to discuss how we'll be grading the strategies in this series. Basically, we look at 4 criteria for each approach. The first is how much income they generate. More income is obviously better, but we'll also be giving a little extra credit to strategies that generate additional income early on, since we're more likely to be healthy and energetic enough to take advantage of that income in our younger years than we are when we're 90-somethings. The second is risk and sustainability. This criteria basically measures how likely you are to outlive your money using a strategy, as well as how easy or difficult it might be to follow the rules laid out by that strategy. The third is the predictability or stability of the income the strategy generates. Basically, this criteria looks at how often your income rises or falls on an inflation-adjusted basis from year to year while using a strategy and how big those changes are. And fourth is how well the approach manages to maintain or raise your buying power over time. Which criteria will ultimately be the most important to you will depend on your goals, financial situation, and personal preference. And because the performance of withdrawal strategies are often heavily influenced by the mix of investments that you happen to hold, we'll also be looking at each approach under a conservative, moderate, and aggressive allocation as shown by this chart. With that being said, let's get into today's strategy. So, real quick for those who don't know, here's how the strategy works. To calculate your income each year, you'll need a few things. First is a base withdrawal rate, which can be anything you want. From what I've seen, the standard figure to use here is 1%. But in order to keep things consistent with many of the other videos in this series, I'll be using 4% today. Later on in the video, we'll go over how changing this figure would impact some of the metrics, but for now, I'm sticking with 4%. Second is a multiplier factor, which determines how sensitive or insensitive you want your year-to-year income stream to be to changes in Robert Shiller's CAPE value. This can also be set to essentially anything you want, but most people seem to set it somewhere in the neighborhood of 0.5. So that's what I'll be doing today. The third is the current CAPE ratio, which you can find on Robert Shiller's website, which I'll leave linked in the description below. And finally, you need the current value of your nest egg before you make any withdrawals. Then, to calculate your income for the year, you simply plug those values into the following formula, where A equals your base withdrawal rate, B equals your multiplier factor, and P equals the current value of your portfolio. If you research this strategy for yourself, you may see sometimes the formula uses the cyclically adjusted earnings yield in place of the 1 divided by CAPE, so the formula would look something like this. That's perfectly okay as well, since the cyclically adjusted earnings yield is simply the inverse of CAPE. So some people use that to display the formula to make it look simpler, but they're basically the same thing. So that's how the CAPE-based strategy calculates its withdrawals. But how well does it stack up in regards to our 4 criteria? As usual, we'll start by examining its historical income generation capabilities. The first factor I look at when analyzing withdrawal strategies is income. As you can see from the chart on your screen now, in terms of income generated on a $1 million nest egg, the CAPE-based approach generally outperforms the $40,000 a year in income that the standard inflation-adjusted approach would generate. However, on the low end, it can miss that mark by quite a bit, especially when using the more conservative asset allocation, which in the most extreme cases could lead to it being difficult to make ends meet when using this approach. The story shifts in the early years, with all 3 allocations significantly outperforming the $40,000 a year in income, even at the lower end of the spectrum, suggesting that at least with the assumptions that we used, the CAPE-based approach tends to front-load its income more than the standard approach. The second factor that I look at when analyzing withdrawal strategies is risk and sustainability. Risk, or the likelihood that you'll outlive your savings, examines a couple of key metrics. The first is what I call the approach's survival rating, or the percentage of possible retirement starting dates that would have avoided running out of money over a specified length of time. In this series, I'm using 30 years as the time frame to determine if an approach survived retirement. The second is what I call the approach's depletion time, or how long the approach survives in its worst case scenario. This is important to consider because while two approaches can have the same likelihood of making it at least 30 years, they can have wildly different worst case scenarios. Sustainability considers how easy or difficult an approach is to maintain given the experiences that its strengths and weaknesses are likely to produce. Starting with survival rating, we see that the CAPE-based approach performs fantastically. Not only did it manage to avoid running out of money over the course of a 30-year retirement, regardless of the starting date used, but it also avoided running out of money, period. Someone who retired with an aggressive, all-stock portfolio in 1929, just before the onset of the Great Depression, would have still had money to spare in 2022, over 40% of the original nest egg, in fact. And that's even after adjusting for inflation. That's pretty darn impressive, considering that the strategy was also providing superior overall income compared to the standard inflation-adjusted approach during that time. So yeah, when it comes to risk, the CAPE-based approach appears to be pretty darn solid. In terms of sustainability, it's a bit more of a mixed bag. On the one hand, I think there are a lot of retirees who would really like the idea that their strategy will adapt to the expected future returns on their investments. When the stock market experiences an extended run-up like it did in the 1990s, you would expect that there will eventually be some sort of a regression to the mean. So on the surface, it would make sense that you'd want to rein in your withdrawals, at least to some degree, which is exactly what this strategy does. The CAPE rises when share prices rise faster than earnings. And since part of our income equation uses the inverse of CAPE, our income will be reined in to a degree as those prices are rising, which will lead to us having a larger cushion should a drawdown happen. That's why this approach did so well in terms of survivability. On the other hand, you will need to be willing to be pretty flexible with your retirement budget to follow this approach as originally intended. It's not uncommon to experience 4 or even 5-figure changes in income from year to year, especially with those more aggressive allocations. Which brings us to income stability. The third factor that I look at when analyzing withdrawal strategies is the predictability or stability of the income stream it produces. And while the CAPE-based approach is not the worst strategy we've seen in this area, income stability definitely isn't going to be considered one of its greatest strengths. As you can see from this chart, anywhere from roughly half to nearly 2/3 of the years see a cut in income on an inflation-adjusted basis. Now, the median cut isn't always that bad. Using a moderate allocation, it's usually only a few $100s, which I feel most of us would be able to manage in retirement. However, the conservative and aggressive allocations typically require adjustments north of $1,000 in any given year, for better or for worse. And at the extremes, we're well into the 5-figure range. Granted, that isn't all too uncommon to see for strategies that we've covered in this series. However, as I said earlier, 5-figure adjustments are quite normal for this approach. Take the last 30 years, for instance. Someone who retired in 1992 would have had to adjust their income by at least 10,000 inflation-adjusted dollars from one year to the next 13 times using an aggressive allocation. 5 of those times were income cuts, with the largest coming in at over $55,000. Now, is that a deal breaker? Not necessarily, but it is definitely something to take into consideration. The fourth and final factor I look at when analyzing withdrawal strategies is buying power. And this is another area where the approach struggles. Looking back at our average income figures over the early portion of retirement, so the first 5 years, and the overall 30-year retirement period, we see that under all 3 allocations, income levels are higher in the early going than they are overall, suggesting that income levels later on in retirement are lower. That's also not necessarily a deal breaker, as it's been shown that most retirees actually see their inflation-adjusted spending decline as retirement rolls along, up until the point where medical costs start rising at a fast enough rate to make up for the lowered spending in other areas of the budget. This phenomenon is known as the retirement spending smile and is depicted in the graph that you see on your screen now. But it is still a weakness worth noting nevertheless. So in the end, what we've got is a strategy that manages to produce very respectable levels of income, especially early on, without suffering in the risk category. However, its income stability is not its strongest suit, even if it is better than some of the alternatives like a simple fixed percentage approach, and this relative weakness is indicated by its tendency to see income cuts of thousands or even tens of thousands of dollars with relatively high frequency. In the most extreme examples, this could lead to you struggling to make ends meet based on the withdrawal amounts allowed by this approach. And over the longer term, its ability to maintain or raise its buying power may or may not be all that great depending on the asset allocation and assumptions used. Like I said at the start of this video, I used a base withdrawal rate of 4% and a multiplier factor of 0.5, and under those assumptions our buying power decreased over time under all three allocations. However, if we used the more standard assumptions of a 1% base withdrawal rate and a 0.5 multiplier, that may change. Here are the average income results for the early and overall categories for each allocation under those assumptions. The survivability and income floor picture remain pretty much the same, i.e. the strategy never runs out of money, but minimum income levels may make it difficult to make ends meet during the leanest times. And the income stability issues are still present, but by trading off some of your overall income generating capabilities, including much of the impressive early income levels that we saw, you do manage to improve your buying power over time using a more aggressive allocation. Given that the moderate allocation barely managed to raise its buying power and the conservative allocation failed to maintain its buying power even under these new assumptions, I'd still say that relative to many other strategies that focus on this aspect of retirement income planning, this is a weakness of the approach. But it's worth noting that this is an aspect that can be optimized to some degree by using different assumptions than the ones we did in this video. So that's the CAPE-based withdrawal strategy. What do you think of it? Let me know in the comments section below. But that'll do it for me today. Once again, if you enjoyed this video, be sure to smash that like button if you haven't already, subscribe, and hit that bell next to my name so you'll be notified of all my future uploads. I generally upload every single Monday, and if you have a friend that would be interested in this kind of content, be sure to share it with them. Let's really get this information out there and start our own financial revolution.